All right. FOMC meeting minutes. Let's see what the market have done today. So 4-hour target, that is this close. Let's see if we can manipulate some hourly highs. Hourly highs. And yes, let me see if I can pull up the stream also. Let me find it here. Can't find the live. Let me see what live we can watch. Okay, let's see.
As governor when your term is chair.
Thanks, Mr. Chairman.
I
guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market in the short term?
With what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of how do we think our communications can be improved. there are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, you know, I would only I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received and not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today, and you didn't cut today?
Well, the forecast for inflation in December was 2.5%. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be, we've learned that tariffs are going to be substantially larger than forecasters generally thought. And, you know, we don't, our forecasts are generally not.
This is the wrong one. The market is pushing higher now. Let's see. Yeah. Taking out. High time frame liquidity right there. We also maybe take out this. Yeah, I took out. I'm gonna short. Yes. Yeah, he cut the rates. I'm short. Let's see, shorted from around here, stops above this high and targeting the lows all the way down here. I will take additional profits on the way down or up. I've never traded FOMC, so it's my first time, so I will just try do something. But we took out high time frame, so it makes sense to short, I guess.
Particularly different from those of.
Yeah, and follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward.
Ifs barneforsikring hjelper mye. Sjekk din pris.
If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say.
I might
so
just took
again,
the trade a little
we think
bit
that our current
early.
stance of monetary policy is in a good place.
I might just want to go up and take out these highs also, but I will try a little bit today.
Thank you. I'm Mara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no. And I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do. We work hard, but I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public. We're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it, again, respecting that we have critical missions to carry out. I've had a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. we're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
We took out these highs. Might just go.
And Chair Powell,
Sure.
Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous. And so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate. But it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, and worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Victoria.
So let's see. We're doing if I lose this trade.
Hi, Victoria Guida with Politico. So
$50.
you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that, a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Is that affecting at all who
No,
you're consulting with?
Not at all. Not in any way.
Everyone raising their hands to.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation, and what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is, and it's just a different thing. So I think this is something that certainly has transformational potential, and probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive, and there are those who think it's going to replace an awful lot of jobs right across the income spectrum. White collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar, movements of the dollar was impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint. You see this not just here, but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. And it doesn't change our objectives or what we need to do. And, these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know, though. So both housing services and non-housing services have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects.
Oh, fuck. Fucking
December to today and adjusted over the full time horizon you've got there. You've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April after the March meeting that substantially higher tariffs were likely, and then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished. On that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. It's uncertainty. So I think that's an accurate statement.
Yeah.
Thank you. Chris Rugaber, Associated Press. There is an argument out there in favor of cutting rates more immediately, inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about, cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, And it's a pretty, I think all estimates are now pretty close together, but it's again, highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But, the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this, and I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen.
You know your business better than anyone, right?
No.
So why not build an app to run it with Base 44? This finance
effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise
that the unemployment rate continued to edge up reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months.
I'm getting stopped out right
In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
Yo, what's up?
Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%.
Got stopped out.
These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower
Can you hear me now?
for the federal funds rate by a quarter percentage point.
I have bought a new mic.
3.75%.
Let me.
In the near term, risks to inflation are tilted to the upside.
Do you hear me better now?
Risks to employment to the downside. A challenging situation.
Yeah, okay, good. I just turned around. I've ordered a new microphone also, but
between
yeah,
our employment and inflation goals.
I got stopped
A
out
reasonable base case is that the effects
this.
of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level.
I want to short
Our
again,
obligation is to make
but
sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered the policy rate 3/4
I shorted. I misclicked.
3 meetings.
Damn.
This further normalization of our policy stance should help
Nah,
stabilize
fuck.
the labor
I need
market
to exit this
while
trade.
allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September.
No, I want to go short. We have taken out all the liquidity. I want these lows to get taken out. So I might just marry my bias and down.
Expedia, made to travel.
Implementation of monetary policy, with the reminder that these issues are separate from and have no implications.
But I'm not really sure right now. I've lost 2 trades going short, so I might just go long.
In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases
Yeah, I
in
know it's
security
showing strength,
holdings
but I
ensure
just need
the
some
federal
bad
funds
news to
rate
come
remains
and
within its target
we
range
flood.
and are necessary
But yeah, I
because the
know.
growth
But
of the
I can't
economy leads to
go long
rising
here. I
demand
should have
over
done it
time for our
down here, but
liabilities, including currency and reserves.
yeah, I know.
As detailed in a statement released today by the Federal
But as
Reserve
you
Board
see,
of New
there's
York,
no liquidity
reserve
up here.
management purchases will
It has to
amount
be
to
these highs then.
$40 billion in the first month and may remain elevated for a few months to alleviate expected near-term
These
pressure
lows
to the money
looks
markets.
promising also.
Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum
Yeah, now we're
employment,
getting a
bringing our
huge
inflation
push down.
sustainably down to our 2%
I
goal,
wanted to short.
and keeping
Oh
longer-term
fuck.
inflation expectations well anchored. Our
Well,
success
it's
in
huge
delivering
push,
on
but
these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do
the high
is in
of the
service to our
daybreak.
public
What do you
mission.
mean?
At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with
These
Reuters.
lows just look so
First
promising
turning to the
today.
statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of
I've
the economy
not been
along
looking for longs today,
this
to be
time?
honest.
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And
Are
as
you
we
in any
noted our
positions right
statement
now?
today, we are well positioned to determine the extent and timing of additional
But
adjustments
yeah,
based
fuck.
on the
I should have
availability,
shorted.
the evolving outlook, and the balance of risks. That new language points out that we'll carefully
Now we
evaluate
are.
that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall,
Closing on these
the
lows right
baseline
here.
expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9.
Oh. Is it mine that's lagging?
En, to, tre, fire, fem eller seks.
Nå lanserer vi I Godt levert matkasse.
A risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal.
Are you in any
between
positions,
now
you,
and the January
NA?
meeting, and I'm sure we'll talk more about that. And that
Or
will,
mix
the data
fund.
that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September. We've cut now 3. We now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned
I wanted to
now
long
puts
this
us
because we have a 1 minute
well
S&P,
positioned
but
to wait and see how the economy
as I'm going to
develops.
check how much I would have been risking,
Just follow
it
up on
takes
the
off.
SCP. You have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So it is, the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see. And I think it's actually
It would have been a nice trade to take.
What you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And we come together and we reach.
Refresh.
I'm going to London at April.
Do you mean I am going to London in April?
I'm going to London in April.
Support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down? Or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation. And as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation. But we're going to start to see the data, and it'll tell us whether we were right or not.
Okay, made back
Pleasure,
my
it's
losses,
Financial
and
Times. A lot of people interpreted your
I
comments at the October
risked
meeting that,
my whole
there was
account
a bubble
and
situation, we slowed
made
down,
some
to
nice
mean
profits.
that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the
And
committee
let me
decide
just take out this
to
full
move
clip of it.
today rather than to move in January instead? Thank you.
Right. So in October, I said
Yeah.
that there was no
TP.
certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently.
That's nice.
Why did we
Oh,
move
it feels
today?
good.
I would say point to a couple things. First of all, gradual cooling in the labor market has
We
continued.
went
Unemployment is now up
long
3
from
tenths from June
around
through September. Payroll jobs
there.
averaging
Stop loss was
40,000
under
per
there,
month
and I
since
targeted
April. We think
around
there's an
there.
overstatement in
But
these numbers.
now I
About
look and I
67,000,
could do.
so that would
Oh,
be
on yes
negative
it was.
20,000
Okay,
per
let's see.
month. And also, just to point out one other thing, surveys of households and businesses both showed declining supply and demand for workers. So
There we go.
I think you can
But
say that
I could have
the
maybe
labor market
targeted
has continued to cool gradually,
these highs.
maybe just a touch
Let's see
more
if that
gradually
would
than
have
we
worked
thought.
out.
In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do
Let's
we
just
see
if we can
what's
look
going
for
on with
some
wages?
shorts. I still want the shorts.
Isn't lag the worst? Well, with ExpressVPN, say goodbye to higher ping and lag spikes. Gaming with ExpressVPN is a no-brainer. There's ultra-fast VPN servers to handle fast-paced gaming, access to servers in 105 countries. You can always find one close to the game server you're playing on.
Okay, we
and you're
took
covered
out
on whatever
these
device,
eyes.
whether that's your PC, your
I would have
console, or your
had a
smartphone.
nice
Level up with
entry on
ExpressVPN
ES.
today.
Some of
But
the tensions we've
was
seen in
checking
money
how
markets.
much
I wouldn't say concerned. So what really happened is this.
The entry ran away from me.
Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right?
Look at
and
the
it
chat.
ticked up almost all the way
Just
to
trolling around.
interstorm reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th.
Yeah, I know.
There's also
managed
a
to.
secular ongoing
Yeah, it took a long
growth
on
of the balance sheet. We have to keep
NQ.
reserves
I can show you.
call
I
it
took this long,
constant
and
as
I
it
targeted
relates to the banking
just
system
these size.
or to the whole economy.
You
And
were
that
right.
alone
I
calls
was
for us
wrong.
to increase
Can
about
admit
$20,
that.
$25 billion per month.
Now I'm just
So
angry
that's a small
I didn't
part.
target
That's
these
going
highs.
on. It's
because
also happening
I
in the context of a
reported my shit.
temporary few month
So yeah,
front loading
I
to
should
get
have targeted
reserves
these highs,
high
and I
enough to
would have
get
made
through the tax
thanks today.
period in mid-April. So that's what's happening there.
But yeah,
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators.
Yeah, I can't join now. It's too late. I entered here and exited right here. I can't enter now. Where should I put my stop loss? There's no. I'm looking for shorts again.
I don't know if that means I get 3 questions.
Looking for shorts from up here. If we make an S&P divergence, maybe I short all the way down here. Ah, fuck.
I don't think it rises to that level.
But yeah, maybe you want to see this.
In 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s. Let's put it that way. But we do have tension between our 2 goals, and so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that in our framework.
684.
Says that when that's the case, that we try to take a balanced approach to the 2 things.
Oh, you're long from all the way down.
Get them back to each of them back to the goal.
Here.
And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately
around here.
Is
that right?
Broadly,
yeah.
Equally threatened, equally at risk.
Nice.
You should be kind of neutral. Because if
you entered before the rate cuts, right? Or did you? Yeah, you did enter before the rate cuts, right?
Moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
You must have entered before.
Mr. Chairman, Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process?
No, but you enter. I know, but you must have entered
so with tariff
on this entry. If you entered here, you must have done it before the rate cuts decision.
They start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the world.
Let me check.
Quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a
this one?
So we actually look at it, all of the announcements and
the stocks.
And what you get from all that, you see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is.
Oh, here,
but
this one was.
The first quarter or so of next year should be the peak. And from here,
you entered here. Ah, okay, yeah.
It shouldn't be big. It should be a couple.
Yeah, well, I wanted to enter right here.
Decision on this, but and after that, again, if there are no new tariffs that
but
are being announced,
I didn't manage to
take 9 months to get fully in.
Catch it. I wanted to check how much I would have risked on paper trading, but then we saw the candle shooting up, and then I didn't want to join
a new Fed chairman. Does that hinder your current job right now?
Because after this candle, it would have been like, fuck.
No mulligans for it.
Yeah, I know.
I
saw that. It's just a stock or, yeah.
10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very.
When are you looking to exit on ES or SPY?
And they're at very comfortable levels. They're at levels consistent. Once you get out past the very.
Yeah, look at this. I was wrong. I can admit that. I was horrible wrong.
Consistent with 2% inflation. inflation.
Oh.
There's nothing happening with rates going up
Oh my God.
there that suggests
I
concern
want it,
about
but look at
inflation
these
in the long term or
these
anything
lows.
like
You
that.
can't
I mean, I
tell
look
me
at
they
these
don't
things
look
pretty
promising.
regularly. Same thing with surveys. Surveys are all saying that
They
the
are
public
stacked up
understands our commitment to 2%
under each other,
and
and
expects us to get back there.
on the ES also. Look at
So
this.
why are rates going up? It has to be something else. It must be, an
Yeah.
expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we
might get, let's see, all-time high from here is just, we might get all-time high on SPY.
Really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation.
I should have held this trade from down here.
So that's
Imagine.
And so the best thing we can do
I exited
is
here.
restore inflation to its 2%.
Yeah, easy.
Our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some
almost equal highs.
Higher, it's positive, significantly positive. So nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling economically healthy again.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply
100%.
has also gone way down,
Or
so the
like,
unemployment rate hasn't moved that
not
much. But
just today, on the other days I set my take profit and I hold it. But I have done some. The last week I did one major. I did at one time, and yeah, I lost, like, I could have won just a lot more. And today also, but today it's like I risked everything at the whole trading account, so it was like stupid trade, no risk management. That's why I had a tight stop loss, but yeah, it's still a nice risk to reward though.
And we do think of those as likely
a 3 risk reward is I'm happy with.
Likely to be a one-time,
but like this would have been absurd.
One-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance.
Do you have any tips for me if I want to hold my trades longer?
If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market. Because the labor market, unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both
levels.
I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity.
Most of the times,
make sure that.
Yeah, my levels is the draws on liquidity for the day. So yeah, yesterday I can show yesterday also. I did paper trading, but
with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is? To follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh well. we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody, they have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted.
Oh, my bad.
And, so there's an overcount in the payroll job numbers we think continuing.
Look at this.
And it will be corrected. I don't have the exact month in my head right now, but
yeah,
that's just
here also
again,
I would have
forecasters generally
hit full
understand that.
TP
So,
if I
and
didn't
we think
exit.
it's about
This is just
60,000
paper
a
trading
month,
though.
So
But
40,000 jobs could be -20, and
here
that
also
could be wrong by
entered.
10 or 20 in either direction. But in any case, but the thing is that's
this was just
job
paper trading, and
creation,
this one I
right?
just held.
That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just
But yeah, I will just like set
and
and
you really
forget.
don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative,
true.
I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much
I have
right now
something to learn at least. I will focus on this the rest of the week. 2 days left on this week.
It's probably part of the story. It's not a big part of
I
the
haven't
story yet.
been
We don't know
trading
whether it will be.
anything
But,
this week.
For
I need
example,
to
if you
step
look
up
at,
that. But
you can't miss
yeah,
the
today
big
was a no
announcements of
trade day for me,
layoff
just
and
because
they
of all
cite
the
AI.
news.
That's all clearly happening. At the same time,
And
people
tomorrow
are not filing for unemployment
it looks
insurance.
good.
And
And
since
Friday
job
also
creation,
looks good, but
job
then I'm
finding
going
rates
to
are
work,
extremely
so
low.
I might
If there
just
were
skip work.
big numbers of layoffs, you'd expect
I don't know yet.
the continuing
I want to
claims
trade though.
to go up, and you expect new claims to go up. But really haven't much. So it's a little bit curious. Longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past.
No, let me just reset the novel. Yeah, true. I don't trade stocks though, but yeah. I only trade the futures right now. But yeah, I know every single day the last week I've known where the market wants to go. I just can't find the trade entry. And my what is it?
Make it a habit.
My take profit is also always the liquidity for the day.
All the way forward.
Factor in what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing. Please,
but yeah, it looks like we are closing to this side.
I don't know. It would depend.
Nice also.
It would depend on a whole bunch of things we don't know. So I can't really help you there.
Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really
Trump
driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and
I only think it's like a test.
Values are high, and they tend to be owned by people more at the higher end of the income and wealth. So, as how sustainable it is, I don't know. Most of the consumption does happen by.
Get 72 hours of unstoppable moisturization. New Nivea Body Milk.
I haven't done it.
Pure hyaluronic acid के साथ जो moisture lock करे.
Are you trading oppositions or just options, like options and oppositions?
To have a, price stability and a strong labor.
Because
what we saw, for example, what we saw at the end of the, the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time homebuyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant
because
challenges.
I can buy stocks and stuff, but options, is it like oppositions or?
Decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move, and we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the
you
tools
don't have to get
a secular
verified to trade them.
shortage,
No,
structural
you can just
housing
buy and sell whenever you want.
Thanks.
But
Chris Ruby,
my
Associated
broker is
Press.
open because I am in Norway. I
mentioned
used
on
the
inflation,
Norwegian one, and
services
they
inflation
close
being low, goods inflation looking like maybe it'll peak.
16.
We had the wages report you mentioned today showing
Let me check if I can.
moderating wage growth. Where are the inflation risks? It looks
Oh,
like
never mind. Yeah,
inflation
I can do that. Yeah,
cooling, in your view, at the same time you
I
have
can.
potentially
You don't need to
negative
get
hiring.
verified.
Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we expect.
Yeah, I know. But
most of us,
right now,
that
I am
inflation will be a one-time
got a
price
lot of
increase and
crypto,
then come down.
and I just
We
need the
came off an
crypto to,
experience where inflation turned out
crypto
to
hasn't
be
done so well
much more
in the last
persistent than
few weeks.
anyone had expected.
So
is that going to happen now?
I need it to.
So that's the risk. The risk is either that
high.
tariff inflation just turns out to be
Yeah,
more
I know.
persistent, maybe because
Absolutely. I've been looking at them right here, every single one, and I've marked out levels I want to buy, and look at this one, bottom ticked it, but yeah, I didn't have any money ready for it. What the fuck is happening now? Oh fuck.
I learned that ChatGPT
No, I don't want
works
more
best with
fucking.
detailed prompts, but I hate typing them. So instead, I dictate.
Companies who are now, and this is the assessment we made.
Yeah, I know. When I'm get out of crypto, I will
Neil Irwin with
see you
Axios.
later. God bless you.
This has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5, 6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I